Hello, everyone, and thank you for joining us. Welcome to our third quarter 2026 Market and Economic Themes webinar. For those I haven't met, I'm Mike Minter, Chief Investment Officer here at Financial Synergies. And over the next 30 minutes or so, I'll try to keep it briefer than that, but I want to talk to you about the 10 themes our team believes are likely to shape markets and the economy over the coming quarter. If you take one thing away from today, I hope it's this. The second quarter was one of the more eventful 3-month stretches we've seen in a while. A war, an oil shock, a jump in inflation, and a Federal Reserve that changed its tune entirely, and yet the market came through it and traded to new highs. That tension between a noisy headline environment and a resilient market is really the story of the quarter. And it's the thread I'll be pulling on throughout the presentation. So here's our roadmap. We'll start with a recap of what actually happened last quarter, then dig into the forces driving markets right now, the extraordinary rally in semiconductor stocks and the AI spending behind it. From there, we'll look at how the market's gains have started to broaden beyond big tech, what's happening with corporate profits, and the interconnected stories of oil, inflation, the labor market, and the Fed. We'll close on the capital markets and the key questions we're watching into year end. A few themes will keep recurring throughout: AI spending, the broadening of the market, inflation, and Fed policy. So keep those in the back of your mind as we go through this, because they tie almost everything together. So let's get into it. What you're looking at here is the S&P 500 over the second quarter, with the major market and economic events of the period layered on top, so you can see how the story unfolded in real time. The headline number is this: the S&P 500 gained roughly 14% in the quarter and finished near all-time highs. That was its strongest quarterly return since the second quarter of 2020, back in the early days of the pandemic recovery. But the number alone doesn't do the quarter justice at all, because it was really a story of steady improvement out of a very difficult starting point. So we came into the quarter still under pressure from the first quarter sell-off. As it turned out, that starting point was the low for the entire quarter. The trouble in Q1 had been driven by the conflict in the Middle East and the resulting spike in oil, which peaked near $115 a barrel back in early April. And then things began to really turn. A U.S.-Iran ceasefire was announced. Oil fell back below $90, and that diplomatic relief, combined with strong first quarter earnings and a nearly 40% rally in semiconductor stocks in April alone, kicked off a dramatic recovery that gathered momentum for the better part of 2 months. The Fed held rates steady at the end of April, though that meeting produced the most policy dissents in over 30 years, an early sign that the committee was not of one mind. The rally rolled right through May. Kevin Warsh was confirmed as the new Fed chair mid-month. Volatility fell as tensions eased, and the index tacked on about 5% for the month, capping a 9-week winning streak. And then on June 2nd, the S&P 500 set a fresh all-time closing high. The back half of June is where it got interesting again. Inflation data in early June showed consumer prices up 4.2% year over year in May, a 3-year high, driven by that spring oil spike. After that hot report, the Fed held rates again on June 17th, but signaled its next move could be a hike rather than a cut. And questions about the sheer scale of AI infrastructure spending began to weigh on semiconductor stocks, which had become a pretty crowded trade. Even so, risk appetite stayed strong. SpaceX completed the largest IPO on record in June, raising about $85 billion, and oil round-tripped all the way back below $70 as the Strait of Hormuz reopened. So, a war, an energy shock, an inflation scare, and a more hawkish Fed And the market still finished up 14%, not too bad. So each of the storylines behind that headline deserves a closer look, and that's exactly what we'll do next. If there was a single engine behind the quarter, this is it. What you're seeing is the quarterly price return of the semiconductor index going back to 1996. So nearly 3 decades of history in one view. Semiconductors are the advanced chips at the center of modern computing and increasingly the entire artificial intelligence build out. So the story here is impossible to miss. That bar on the far right, the second quarter of 26, towers over almost everything that came before it. Semiconductors returned 88% in a single quarter. That's the strongest quarterly return in the history of that index. To find anything close, you have to go all the way back to the late 1990s, a 68% gain in the first quarter of 2000, and then a 65% gain in the final quarter of 98. What makes this rally distinctive, though, is the driver behind it. This was an artificial intelligence story from start to finish, really. The largest technology companies are spending hundreds of billions building new data centers and buying the advanced chips required to run them. And the semiconductor industry is the direct beneficiary of this. Record earnings, growing order backlogs, and companies signaling still more spending ahead. So now here's where I'd have you think about a move like this. A quarter this large is genuinely historic and it deserves to be recognized. The market is treating AI as a major technological shift, and the earnings growth behind the rally is real. But a move of this scale also tells you how much future growth is already being priced in today. Over time, that spending has to translate into actual profits to justify the investment. And that becomes especially important as a growing share of it is being funded by issuing new debt and new stock. The closest historical parallel, the late 1990s, is instructive precisely because it points in both directions. Rapid transformative change tends to bring real opportunity and elevated expectations at the same time. That's the balance we're weighing. And it naturally raises the question, where's all this spending actually coming from? And that's what we're going to cover on this next slide. So this slide answers the question, the last one just raised. Why did semiconductors rise nearly 90% in a single quarter? The short answer is that an extraordinary amount of money is flowing into artificial intelligence, and a large part of it lands directly with the companies that make the chips. These two charts show the spending from two angles. On the left is the year-over-year growth in business investment in technology equipment and software, like computers, servers, networking gear, and the like. And in the first quarter of 26, that spending grew 19.1% compared to a year earlier. That's a faster pace than even in the late 1990s, when the arrival of the internet set off a comparable surge in tech investment. So this isn't just a stock market phenomenon. It's showing up in the hard economic data. The chart on the right zooms into the company level. It shows the combined annual capital expenditures of 5 leading AI companies. These companies, I would say, are leading or building AI infrastructure and taking the lead on that. We have Microsoft, Alphabet, Amazon, Meta, and Oracle. And that trajectory is striking. So back in 2016, those 5 companies invested about $32 billion combined. By 25, that figure had grown to roughly $416 billion, nearly 13 times as much. And this year, they're projected to spend about $724 billion. And next year's estimate is close to $900 billion. That money pays for the data centers, the chips inside them, the networking equipment that ties it all together, and the electricity and cooling required to keep it running. So, here's the important nuance, and it's a reassuring one, I think. Unlike some past bubbles, this spending appears to be anchored to real present-day demand. The companies doing the spending are telling us that they're limited more by how fast they can physically build than by any shortage of demand. That's a meaningful distinction. It means the semiconductor rally we just saw and discussed is grounded in actual purchase orders, not pure speculation. And it's supporting a whole ecosystem. The chip makers, the data centers, the equipment suppliers, and the utilities that power them. The question worth watching from here is simply how long this pace can continue, because spending on the scale eventually has to be justified by a return on that investment. But make no mistake, this CapEx boom is the fundamental force sitting underneath a lot of what we'll talk about today. So far, we've talked a lot about big tech, but one of the most encouraging developments this year is what's happening beneath that headline. And this slide tells that story. Here, we're comparing the year-to-date total return across 5 different parts of the market. Starting on the left, the S&P 500 was up 10.2% at quarter end. Obviously, everything we're looking at today ends on 6/30, June 30th. But strip out that technology sector and that return drops to just 5.1%. That gap tells you how much of the headline number has come from a relatively narrow group of tech stocks, the very companies we've been discussing. Now, look at the right, and you see real strength across the rest of the market. Mid-cap stocks, the S&P 400, for example, were up 17%. International stocks outside the U.S. up almost 17%. And small caps via the Russell 2000 index have gained 22%, leading the entire pack. So every one of those segments has outperformed the S&P 500 this year. So why does this matter so much? Because for the past couple of years, a handful of mega cap tech names did almost all the heavy lifting, and smaller and international companies lagged badly, partly because of rising inflation and higher interest rates, and partly because those indexes simply don't hold the big AI names dominating the headlines. So to see them not just participating, but actually leading is a genuinely healthy sign. Market breadth is improving, and that's exactly the kind of foundation you want under a kind of rally like this. It's also a real-world reminder of why we build portfolios the way we do. By holding a mix of company sizes, geographies, and market factors, you don't have to depend on any single corner of the market to carry you. In a year when the headline index has leaned so heavily on tech, diversification has been quietly doing its job in the background. And as it happens, part of the reason those smaller companies are doing better ties directly into our next slide, which is corporate profits. This slide gets underneath the small cap outperformance we just saw and asks, why are these smaller companies suddenly doing so much better? The answer is profitability. What you're looking at is the rolling 12-month net profit margin, the Russell 2000, the roughly 2,000 small cap companies in that index. A profit margin is simply the share of each sales dollar a company keeps as profit. So a higher line means a more profitable business. Small cap margins move in cycles, and you can see the major stress points right on the chart. Margins turned negative during the 2008 financial crisis, stabilized through the 2010s, and then dropped again during the pandemic when the economy effectively shut down. They rebounded strongly in 2022, peaking near 4.8%, but then came a genuinely difficult stretch from 2022 through 2024. Inflation hit a 4-decade high, the Fed raised rates sharply, and small cap margins compressed to a low of about 2.7% in late 2024. Here's the key reason smaller companies got hit harder than large ones during that period. They tend to carry more floating rate debt. So as the Fed raised rates, their borrowing costs climbed almost immediately. Many larger companies, by contrast, had locked in, cheap long-term financing years earlier and were largely shielded from these rate hikes. It's a structural difference and advantage that really matters in a rising rate environment. Now, look at the right side of the chart. Margins have recovered since late 2024 and currently sit around 3.6%. And the reason is essentially the mirror image of what squeezed them before. Inflation has come down from its highs, and the interest rate burden that defined 2022 and 2023 has eased as the Fed cut rates. So those interest rate savings are flowing straight back into the bottom line of companies that borrow at floating rates. It's a big part of why we're seeing renewed investor interest in smaller companies. The durability of this recovery will depend in part on the path of rates, from here, which, as you'll see shortly, has gotten more complicated. But the trend is encouraging, and it's a fundamental reason the market has begun to broaden beyond just those large, mega cap names. Now, let's turn to two of the biggest economic stories of the year: oil and inflation. Because as these two charts will show, they're really one story. On the left side is the price of WTI crude oil over the first 6 months of the year. So oil started the year in the upper 50s. Then in late February, everything changed. The conflict in the Middle East and the closure of the Strait of Hormuz created a major supply disruption. So prices spiked almost immediately, peaking near around $115 a barrel in early April. And you can see just how volatile it got from there. I mean, the line is jagged because prices swung in every new headline out of the region. But look at the right side of that chart, the most important part now. As tensions have eased late in the quarter and the Strait began to reopen, oil fell all the way back to pre-conflict levels, around $70. Obviously, all this is ongoing. It's volatile and fluid, as we know. But that rounds out the end of the quarter story there. The chart on the right is the rate of inflation measured by the consumer price index. And inflation peaked above 9% back in 2022, then fell steadily and settled into around 2.5% to 3% range. But that spring spike in oil pushed it back up to 4.2% in May. That was a 3-year high. And the cause was almost entirely the jump in oil, because energy touches everything through transportation costs. So here's the critical point to keep in mind here. Inflation data looks backward. That 4.2% May reading captures the period when oil was near its peak, not where oil trades today. So when you put these two charts together, you get a genuinely encouraging picture. The inflation rise was driven primarily by oil. Oil has now fallen back to where it started, and inflation is widely expected to ease in the months ahead. So this matters enormously for the Fed, and it sets up the next two slides. That oil-driven inflation spike is a big reason the Fed shifted from thinking about rate cuts to weighing a possible rate hike. So the recent decline in oil should relieve some of that pressure, and the Fed will likely stay patient in the long term. Patient in the near term, I should say. But a sustained move lower in oil and inflation would give it more room to move later this year. The key question here is whether the next few inflation reports confirm that the spike is rolling over. Inflation is only half the Fed's job. The other half is employment. The Fed is charged with both keeping prices stable and promoting full employment. And so to understand what the Fed does next, we have to look at the labor market, and that's this slide. On the left is the monthly change in non-farm payrolls, how many jobs the economy added or lost each month. And you can see the softening that developed through 2025. The pace of job growth slowed, and there were several months of outright job losses. And that weakness carried into early 2026 when the economy lost 156,000 jobs in February. That was concerning, but the trend has since reversed. And so over the 3 months from March through May, job growth averaged roughly 188,000 a month, really solid, healthy pace. So the unemployment rate on the right tells the same story from a slightly different angle. It drifted higher throughout 2025, reaching a peak of 4.5% in November, which was a 4-year high. But as hiring reaccelerated this year, that rise stopped and partially reversed. Unemployment fell back to 4.3% in March and has held steady there for 3 straight months. So the picture is one of a labor market that softened and then firmed back up. And that's good news for the broader economy in its own right. A healthy job market supports consumer spending, And of course, consumer spending is the backbone of the US economy. But here's a connection I would want you to hold on to because it ties directly into the Fed. A strengthening job market reduces the pressure on the Fed to cut rates because the economy clearly doesn't need emergency support. I think about where that leaves us. Inflation is rising and the job market is solid. Both halves of the Fed's mandate are now pointing in the same direction, and that direction is away from Fed rate cuts. And that's a real shift from where we started the year. Pretty dramatic shift, and is exactly what the next slide captures. This may be the single most important shift of the entire quarter, so let me spend a little time on it. What you're looking at is where the market expects the Fed funds rate, the Fed's benchmark short-term rate, to finish the year in 2026. It's drawn from the futures markets, which lets us see essentially in real time, what investors expect the Fed to do. The key reference point is today's Fed funds rate, which sits in a range of 3.5% to 3.75% and hasn't actually changed all year. Now, watch the direction of that line. At the start of the year, the market expected the Fed to cut, pricing the rate down to about 3.06% by year end, which implied roughly 2 interest rate cuts in 2026. On March 1st, that forecast was for rates to end the year around 3%. But since early March, right around when the Middle East conflict flared up, that expectation has climbed and climbed. As of the end of the second quarter, the market now expects the Fed's benchmark rate to finish the year near 4%. That implies not a cut, but a rate hike. So in a matter of months, the market went from anticipating 2 rate cuts to anticipating a rate increase. And importantly, the Fed's own projections in June shifted in that same direction. Why the dramatic reversal? It comes back to everything we've been discussing, which is the Fed cuts rates when the economy is slowing and needs help, and holds or raises them when inflation is too high or the economy is running strong. Coming into the year, the assumption was that a softening economy would force the Fed's hand. Instead, the opposite happened. Inflation rose to a 3-year high on that oil spike we talked about, and the economy stayed resilient with steady hiring. So the Fed lost both the reason to cut because the economy kept expanding and the room to cut because inflation was rising. Now, let me put this in perspective. So this isn't alarming necessarily. Even if the Fed does raise rates, the expectation is that it would be, a modest recalibration, not the start of another aggressive hiking cycle like, back in 2022 or 2023. And the oil surge behind much of the recent inflation has already reversed, which should relieve some of that pressure. So the bigger takeaway is that rates may simply stay near current levels for longer than many people expected. I mean, of course, that does have real two-sided implications for your financial life. One being borrowing costs on things like mortgages and loans could stay elevated for a bit. And on the other hand, savers continue to earn genuinely attractive yields on bonds, CDs, even cash. I mean, it's not bad right now. Which is a positive for anyone relying on that portfolio for income. It's a backdrop we're actively positioning around. Let's shift to a developing trend. And this is in the capital markets, a sharp increase in the supply of new stock and debt coming to market. This chart shows the total money raised through initial public offerings each year. An IPO, as most of you know, is when a private company sells shares to the public for the very first time. You can see just how much IPO activity swings from year to year. It surged to a record of nearly $245 billion in 2021 when markets were booming and money was cheap. And then it collapsed almost overnight, falling below $12 billion in 2022 as rising interest rates effectively slammed the IPO window shut. And it stayed muted through 2023 and 2024, but it began recovering in 2025. And now, year to date in 2026, companies have already raised about $131 billion. That's the most in any year since that 2021 peak. And keep in mind, that figure only covers part of this year. So you got several large companies still lined up to go public this year. This rebound is being driven by two forces. The first is a group of large, well-known private companies finally choosing to go public. And so the standout, of course, was SpaceX, which completed the largest IPO in history back in June, raising about 85 billion, and several other prominent names are expected to follow suit. Two of the biggest names in artificial intelligence, OpenAI and Anthropic, have been widely discussed as potential candidates to list later this year, or maybe early next year. So the second force ties directly back to the AI CapEx story from earlier. The largest tech companies are spending so heavily on AI data centers that it's consuming their cash flow and pushing them to raise large sums in the capital markets. Most of that has come through borrowing, but a growing share is coming from issuing new stock, which adds to the overall supply of shares. So the takeaway is that a significant amount of new stock and debt is coming to market after several quiet years. And for long-term investors, it's largely a good news story. The reopening of the IPO market is a sign of a healthy, confident environment where capital is flowing freely to fund growth and innovation, and it gives investors access, to these companies that were previously available, only to private investors. So a broader opportunity set over time is encouraging. So the natural question with this much new supply is whether the market has enough demand to absorb it all. The SpaceX deal proved the demand is there, at least for the marquee names, but a lot will depend on financial conditions. You guessed it, the path of interest rates in the months ahead. But for now, I'd frame this simply as the market reopening for business and as one more sign of just how much capital is flowing toward the AI build out. So looking ahead, as we wrap up, I want to pull everything together here into three questions our team will be watching most closely, in the second half of the year. We've touched on each of these already. So I think of this as, a short list of what's still kind of unresolved, and how these play out will go a long way towards shaping the path of markets into year end. The first is the path of inflation and interest rates. Inflation hit that 3-year high last quarter, driven almost entirely by that oil spike, but oil has since fallen back to pre-conflict levels, and the expectation is that inflation cools from here. The question is whether that cooling actually shows up in the data. If it does, it relieves pressure on the Fed and could put rate cuts back on the table later this year. If inflation proves stickier than expected, the Fed may raise instead, and that matters to every one of you because rates influence, again, everything from mortgage costs to the yields you earn on your cash savings. The second theme is the AI build out. The spending has been enormous and the market gains have been large. But the question now is whether both can be sustained. This has become a popular crowded trade, and the late quarter pullback in tech was a reminder of how quickly prices can swing when expectations are this high. Over time, all that spending has to translate into real profits to justify the scale, especially as a growing share of it is funded by new debt and stock. Last quarter showed us both the genuine promise of the new technology and just how much is already expected of it. The third theme really is kind of twofold. It's whether the market breadth stays strong and whether corporate earnings can live up to expectations. We saw small and mid-sized companies begin to participate alongside the tech giants with profit margins expanding. The question heading into the back half of this year is whether that broadening continues and whether companies across the board can deliver the earnings growth that investors are counting on. Now, I'll be honest, it's natural to look at a list of open questions like that and feel a little uncertainty, but I'd ask you to remember how the past quarter actually unfolded. In the space of 3 months, the market faced a war, an energy shock, a jump in inflation to a 3-year high, and a Federal Reserve that flipped from cutting to a possible hike in rates. And through all of it, stocks didn't just hold their ground, they traded to new all-time highs. That's not a reason to be complacent, and it's not a prediction at all that the road ahead is going to be smooth. But it is a powerful reminder of why we do what we do. We can't know exactly how these questions will resolve, but what we can do, and what we build every portfolio to do, is stay diversified across company sizes, sectors, and geographies. We keep a long-term perspective and avoid making big bets on any single outcome. That discipline is precisely what allows a portfolio to navigate a quarter like the one we just came through. On behalf of the entire team, I want to say thank you for trusting us with your family's wealth, and thank you for spending time with me today. For our current clients, please don't hesitate to reach out to your advisor with any questions. And we're always happy to walk you through what any of this means for your specific plan. And for anyone joining us as a prospective client, we'd welcome the chance to talk to you about your financial goals. So feel free to reach out to us and schedule a time directly with our team. Thanks, everybody.